let's start asking the AI agent what is going on around the world. And here we are, here we have the response. The US markets are currently driven by expectation of a potential rate cut by the Federal Reserve. These follow a weaker than expected job report, which has increased speculation that the central bank will act to stimulate the economy. All eyes are on the upcoming ISM service PMI and trade balance report for further clues on the health of economy. Okay, so this is the environment where we are moving. And of course, as you can see from the real-time prices, stock market are a little bit upset, let's say. The VIX index is rising. It means the volatility is back on the track. And we have a little bit of rebound on the major indexes. So this is what I expected in the last days. So I would like to share my analysis in order to understand what we can expect in this long summer on financial markets. So first of all, we can go to the S&P 500, and I really would like to share with you the ranking page, because something really interesting is happening right now, guys. Few weeks ago, the entire S&P 500 was really undervalued. But now, with the recent spikes of the S&P 500, look, the overall undervalued situation is now just 2.27%. It means something really interesting, guys. At the moment, if we go and we sum all the fair values for the entire index, which is something the forecaster terminal do automatically, we can say that the S&P 500 is exactly at the same level of its fair value, because just to be completely honest, an undervaluation of 2% is nothing. Okay, so we can definitely say that we reached the fair value of the S&P 500. And this is something really interesting, guys, because in my experience, all the time in the past, every time in the past we reached this fair value level, the institutional investors started to be a little bit scary. And when institutional investors start to be scary, it means they are not buying anymore. And if something happen in the world, talking about the economy with the tariff or with something else, they start to sell. Okay, so when prices reach this level, we are in a complete different environment compared to when we are in an undervalued situation. Okay, and this is very nice because only forecaster terminal all across the globe can give you this number, and it's a very interesting number. If we move to the COT report, guys, here, and we see what the asset managers are doing with their positions, we see something very interesting. Because look, here we have the S&P 500, which is of course at the all-time high, and here in let's say red, we have the asset managers net positions. Okay, and if we compare the net position, it means the long position minus the short position, okay? If we compare the actual level of the net position to the period where we had the previous all-time high, I'm talking about the beginning of 2025, we can see we have the same level of net position. It means that at the moment we are experiencing a divergence between the volume from the asset managers and the prices, because prices of the S&P 500 went up, but talking about volume, we are at the same level of 2025, okay? So the asset managers, as I told you before, watching the ranking page with the fair value of the S&P 500, are not so optimistic, okay? Because as you can see here, the situation is different from what we had, for example, exactly 1 year ago. 1 year ago, in summer 2024, the optimism was very, very, very high. Look, the net position reached all the time a new all-time high, okay? And then they started to sell their long position only when we reached a very high level on the market, where probably you don't remember, but I remember when we reached these levels on the S&P 500 exactly at the end of 2024, beginning of 2025, we had a fairly valued S&P 500 like we have right now, okay? And this is very interesting. What's strange is the non-commercials. Look, the non-commercials are very bearish at the moment because look, they started to sell their speculative position. They started to go short on the S&P 500 at the beginning of 2025. At the beginning, when they started, they were right because the S&P 500 went down. But then, look what happened to the market. Why it's important, guys, this behavior from the non-commercial. When we talk about the non-commercial, we are talking about the hedge funds. So these are guys that speculate long and short on the market, okay? They can go short, they can go long, and this is the difference between asset managers. Asset managers are here for the long term. They only invest long side. Non-commercial, here we have the hedge fund, and so they can go long and short. This behavior, it's happening right now, especially starting from here. It's very important because it's exactly something that happened between 2022 and 2023. Look, this is exactly what happened here. The net position was going down from the non-commercial. They started to bet heavily on the downside. They started to bet short on the market, but the market started to rise and rise and rise and rise. What happened? And in 2023 happened exactly here. It was, let me check, it was in May 2023. At a certain point, they understood they were completely wrong and they started to buy. They started to buy heavily. Look, you can see here. They started to buy because if you would like to cover, if you would like to close your short positions, you have to buy. And what happened? It's history, because the stock market started to rise and rise and rise, and we reached the first all-time high here at the beginning of 2025. Okay, so this is very interesting. The situation is very interesting right now because I think that this will be the uh, the real engine for a very strong upward movement until the end of the year. We have to understand right now that these guys are betting on the short side or on the bearish side of the market, but I really think they are wrong. And then when they will start to cover, to close their short position, the market probably will skyrocket again. Okay, when this will happen? Very simple. We can move to seasonality and we can see something very, very interesting, guys. Look, I would like to show you that at the moment, the current year, the current prices of the S&P are moving exactly like they did in the past. Because look, the correlation. This is the correlation we have between the current year and the different seasonalities. Look, we have 5-year, 93%, 7-year, 94, 10-year, 90%, 15-year, 88%. It means right now the S&P 500 is moving like it did in the past. So if we highlight this period, which goes from today until the very beginning of October, and we move down in the statistics, we can find something very, very interesting. Okay? Because if we look at the statistics, we are almost 50-50. So in this exact period of time, which goes between today, the very beginning of August, until the very beginning of October, we are talking about 2-month period, we are in a time window where we have 50-50 odds that the market can goes up or down. Okay, but as you can see, we are in a moment where there is no an edge over a long or a short. We can really go sideways. Okay, I would like to show you something. If we activate the trended version of the seasonality, we can really see how the pink price, which is the current year, is moving exactly like it did in the past. So we can definitely expect a period, which is the one here highlighted, with, let's say, a little bit of downward movement. Okay, so what will happen? I think we will experience this period of sideways for prices where, for example, today we can see prices going down, And then, starting from the very beginning of October, we can go back to a very bullish trend that will last, in my opinion, until the end of the year, okay? Until the very end of the year, or also January or February, as we can see here. And if this will happen exactly at the end of October, beginning of November, the institutional investor, the non-commercial, the hedge fund, will start to close their short position because look, they are now short. This is the net position, and as you can see, we are below the line, the zero line. It means they are net short at the moment, okay? And so this is very, very interesting because they are acting as they did in 2023, between 2022 and 2023, when they really thought it was time for a continuation of the bear trend, the downward movement, okay? And I really think this is the moment. I really think that on the stock market can happen something like it happened in 2023. Here we are. We can probably have a period exactly like we had in the summer of 2023, where prices go down a little bit and then they start to skyrocket again, and all the hedge fund manager has to close their short position. That means they will have to buy. They have to buy the S&P 500. They have to cover their short position, and this is why I really think since starting from October, the S&P 500 can really skyrocket to a very important all-time high and can reach 7,000 points. We are at the moment at 6,300, and I really think at the end of the year we can reach that level. Okay. Thank you, David, for your feedback. David is telling me that he saw an analysis done by someone else, and they said exactly the same, that the big boys were wrong in the past. And that's it. Here, guys, look, you can see this exactly from the COT report. This is why COT report exists. If you go to the CFTC Commission website and you go here to the commitments of trader, and you go here and you see why the COT report exists, the commitments of traders reports, look, to help the public understand market dynamics. This is why we have the COT report, okay? This is something that tells us that the financial market are really transparent. And as you can see, they are not so optimistic, and the speculators are really pessimistic at the moment, okay? I'm not pessimistic at all because, look, guys, if we go here on this chart on the overview page, look, what you can see on the chart here in green, it's the net income line, okay? We grab all the net income for all the components of the S&P 500 and we plot it on the chart. We do it for the sales, for all the components. We do it for the net income. We do it for every company We do it for every company inside the forecaster. If you go, for example, on NVIDIA, of course, you know NVIDIA, you can see that in the long run, prices of the stock goes exactly where the net income is, okay? So net income and sales, it's what drive prices in the stock market. And of course, it works on also for the S&P 500. Look, what is important to understand, we are now on the all-time high because companies are doing great. We have $2.30 trillion in net income for all the company. We never had so much net income in the history of this index. Okay, last year, 2024, we had 1.81 trillion. Now we are at 2.30 trillion. Can you imagine? Companies are doing great, economy is doing great. So I think that if, as I expect, prices will go a little bit down during summer, we will have the perfect situation for a skyrocketing S&P 500 starting from October until the end of the year. Okay? Antonio, excellent presentation. Excellent presentation. Thank you. I thought you were writing in Spanish. Excelente. Anyway, guys, this is why in the past days I reduced my investment holdings, okay? Because I really think we can experience a little bit of downward movement, okay? So I'm just in protect. I just would like to protect what I did in the past month, and Forecaster, of course, is helping me, and I really think the situation is completely clear at the moment.